Welcome to Sand Compounding. Return on equity is one of the most important and critical factor in the field of investing. When we do analysis of companies, many of us get bogged down by the earnings and the growth and the sales figures. But really, Warren Buffett is the one who really brought in the power of return on equity and the return on invested capital concept and how it can influence the returns one can generate. Here are some of the details. Let's analyze what ROE and ROIC means. This session we will continue to evaluate and understand what return on equity means. So how to calculate the return on equity? The formula is net profit divided over shareholders' equity. Now, return on equity can be disaggregated using the DuPont model, which is quite famous among the investors' world. It can be disaggregated into three components, which are profitability, productivity, and financial leverage. So here's the formula disaggregated. ROE equals net income by shareholders' equity. It could be broken down into net income by sales, into sales by average total assets, into average total assets divided by shareholders' equity. Now the first part of that is the profit margin, net income by sales, which is the profitability. The next part to it is the asset turnover, that is sales by average total assets, how much sales are generated over for the amount of assets used, and that's nothing but the asset turnover or the productivity or efficiency. You have multiple names associated. And the third part of it is average total assets over shareholders equity is the financial leverage. And why is it called the financial leverage? It's because the numerator part of it has got a leverage component, which is the debt, right, liability. So financial leverage is the third component of the return on equity. This is a very powerful ratio, ROE, which could really help investors understand the quality of a business, how much cash and how much capital is required, and how much returns the business generates over the capital deployed. Is to overall to put together in perspective multiple factors like quality of business, how well the management is spreading the assets, how well the management is leveraging or using the power of financial leverage in an optimal way. There are multiple things we can understand by breaking down the ROE. So ROE has a lot of advantages, and return on equity, it's a great measure to assess a company's quality. As we discussed, firms that are achieving just revenue and earnings growth but needs huge amount of capital to achieve that growth will really destroy wealth if the return on capital or equity is less than the cost of capital. So it's important to assess the quality of growth using the return ratios. It also helps understand the return on assets. So when you break it down or disaggregate, you could understand the return on asset or how the efficiency of the business is. And also it helps us understand the productivity part of the ROE and the profitability part of the ROE. And we will delve deep into the return on assets in another session. What are the limitations of ROE? So the biggest limitation of ROE is that financial leverage component can significantly skew the ROE ratios higher. So which means that higher the leverage component, the ROE can go higher, and it means if the firm has a high debt, the third component, which is a factor which can influence it higher. So return on equity also has high there is a component if the firm has high non-operating assets like marketable securities, cash, it can also draw down the return on equity ratio. That's because when you really divide this return on asset concept, you see the return on operating assets and return on non-operating assets. If the firm has high non-operating assets, right, the returns could be muted, especially in terms of marketable securities and cash, which has very low returns or none returns whatsoever. So it cannot be caught in the DuPont model really, the non-operating asset part of it, for which we have to further break it down and which we will discuss in a later session.